As an investor, I love the tech industry. There are so many innovations each year again. This also means for an investor like me, there is money to be made, and each innovation can generate more value for the company. And in today's video, I would like to discuss the two biggest rivals of tech history, Apple and Microsoft. Apple and Microsoft have been battling each other for the market share since the late 1970s, and at various times one has appeared to be dominating the other. But in recent years, some investors have begun to believe that Apple will fall behind as its iPhone becomes commoditized and Microsoft emerges as a top player in the cloud. However, two emerging trends may give stockholders a case for sticking with Apple. Despite their competition, both companies have enjoyed great success. Apple has amassed the world's largest market cap, around $2 trillion, whereas Microsoft has the second largest market cap at $1.8 trillion. And next to that, both have actually built cash hoards that actually all companies should envy, because Apple holds $195 billion in cash on hand, offset by $112 billion in various forms of debt. Over the trailing 12 months, it generated over $80 billion in free cash flow, in comparison to Microsoft, who holds $132 billion in cash against only $60 billion in total debt. Free cash flow for the company came in about $50 billion over the previous 12 months. Now, nonetheless, almost no company, including Apple, matches Microsoft's AAA credit rating. Despite its debt levels, Microsoft has built a track record on financial stability going back to the 1980s. And it could also pay off its debt immediately with existing cash, lowering its credit risk. How does Apple stand out? Apple pioneered an entire industry through the iPhone, and its largest revenue driver for more than a decade right now. And in time, competition from lower cost players using Alphabet's Android, Google, as of course we all know it, and an Android operating system forced Apple to offer lower cost iPhones, causing the company's overall net sales to fall. However, this situation may have changed. The pandemic brought about increased iPhone sales as dependence on such devices rose again. Now, Apple has launched the iPhone 12 5G, and with the 5G iPhone's faster speed, Apple regained some pricing power. This has brought back some of the higher margins that supported iPhone profits in the past years. Now, next to that, Apple has maximized wearable sales as well, in part by promoting health benefits of the Apple Watch, of course. Not only measures one's heart, but also measures the blood oxygen levels and sends out an alert in case it falls. Additionally, Fitness Plus, Apple's fitness experience that works with the Apple Watch, launched on December 14th. Apple partially credited the Apple Watch with taking wearable sales 30% higher year over year in the latest quarter. Now, also Apple's service division, which includes iTunes and the App Store, has achieved a notable success with 24% in a 12-month surge in revenue over the same period. Now, some analysts speculate that services could generate half of Apple's profit by the middle of the following decade. As a result, Apple earned more than $294 billion in revenue over the last 12 months. And this represents a 10% increase from the previous 12-month period. And also thanks to the part iPhone released last fall, overall revenue for the latest quarter increased 21% from year-ago levels. Now, this revenue improvement led to a net income for the latest quarter of almost $28 billion, which is 29% higher than the year-ago levels. And an increase of operating expenses only of 12% helped contribute to the higher profit surge. Now, this growth took Apple stock higher by more than 70% over the last 12 months. And additionally, its PE ratio has risen to 33. Now, this stands out as Apple's multiple struggles to move above 20 before 2020. Still, its 29% net income increase does not match with the growth in its PE ratio during the same time frame. Thus, investors will have to also consider whether Apple now justifies its more expensive valuation. How about Microsoft? Microsoft has also struggled for respect at times. When Satya Nadella became CEO back in 2014, he inherited a company reeling from the decline of the PC and the slowing growth of Windows. As the previous head of Microsoft Cloud and Enterprise Group, he transitioned transitioned Microsoft to a cloud focus. Now this led to the companies becoming the second largest cloud provider with 15% cloud market share. According to Park My Cloud, this lags only Amazon, which pioneered in the industry. Other software supports Microsoft as well. Microsoft 365, which constitutes its Office, Intelligent Cloud, and Security Suite, primarily drives its productivity and business processes division. This division makes up roughly 1/3 of the company's revenue, approximately the same as the year ago. Still, revenue increased 11% from year-ago levels. Now within that division, the Office 365 commercial suite surged 21% during that period, while its Dynamic 365 software, its ERP tool, registered a 38% increase for that period. Now next to that, the company released its latest generation Xbox gaming console late last year. Overall, Xbox content and service revenue increased 30% over the last 12 months. Still, Xbox appears to have fallen short of its peers. You have to see it like this, that Sony experienced 42% growth in its game and networking services division, though Sony did not break out PlayStation revenue separately. Despite the slightly lower gaming growth, Microsoft stock has moved higher by just under 50% over last year. Also, its PE ratio has reached 36. This far exceeds the PE ratio of 15, where Microsoft traded at the time Nadella took over in 2014. Still, the multiple has fallen from a multi-year peak above 60 in 2018, when a one-time tax charge temporarily reduced the income and boosted the valuation. Okay, that actually comes down to the burning question: is it going to be Apple or is it going to be Microsoft? When we come down to these two tech stock companies, I believe that Apple still holds the edge. The 5G upgrade cycle will force all smartphone users to eventually upgrade, supporting iPhone sales and higher margins for years to come again. Additionally, the growth in wearables and services could also add to that revenue growth. Also, with Apple's rising valuation, it still trades at a slightly lower multiple than Microsoft, despite its higher cash flow and profit margins. While this success will not negate Microsoft's bull case, it also gives Apple more potential for higher returns. I'm curious if you agree with my judgment. Let me know down below in the comments what your ideas are. Thank you very much for watching today's video. I'll see you in the next. Happy investing. Bye-bye.